Hello friends, we are going to discuss about break-even analysis. The cost of a product consists of two items, fixed cost and variable cost. Fixed costs are those which remain the same in total amount regardless of changes in volume. Variable costs are those which vary in total amount as the volume of production increases or decreases. As a result, at different levels of activity, the cost structure of a firm changes. The effect on profit on account of such variations is studied through break-even analysis or cost volume profit analysis, which is CVP. This lesson deals with the various concepts, tools and techniques of break-even analysis. Break-even analysis is a costing technique that helps executives in profit planning, and consequently it is essential for them to have an in-depth knowledge about the nature and application of this technique. In a broader sense, break-even analysis refers to the study of relationship between cost, volume and profit at different levels of sales or production, which in accounting terminology is known as cost volume profit analysis. Cost volume profit analysis as a planning tool analyzes the inherent relationship between price, cost structure, volume and profit. The subject expert of this program is Dr. Naseeb Ahmed, Honorary Deputy Director, Center for Innovation and Entrepreneurship and Associate Professor, Department of Commerce and Business Studies, Jamia Millia Islamia Central University in New Delhi. And I am Shivangi Anand. Break-even analysis is the form of CVP analysis. It indicates the level of sales at which revenues equal costs. This equilibrium point is called the break-even point. It is the level of activity where total revenue equals total cost. Break-even analysis helps the management in profit planning. Profits are affected by several internal and external factors which influence sales revenues and costs. Break-even analysis focuses on the way cost and profit change when volume changes. It is, broadly speaking, that system of analysis which determines the probable profit at any level of activity. This technique is generally used to analyze the incremental effect of volume on costs, revenues and profits. There are some questions that the entrepreneurs are interested to know. At what volume of operations are costs and revenues equal? What volume of output or sales would be necessary to earn a profit of say rupees 5 lakhs? How much profit will be earned at a volume of say 20,000 units? What will happen if there is a reduction of 20% in the selling price? What will happen if there is an increase of 10% in the selling price? Questions like these are sought to be answered through break-even analysis. This detailed analysis will help the management to know the profit levels at different activity levels of production and sales and various types of costs involved in it. Let's see the objectives of break-even analysis, which are to forecast profits accurately, to help in preparing flexible budgets, to help in performance evaluation for purposes of control, to formulate proper pricing policy, to know the overheads to be charged to production at various levels. In break-even analysis, the volume or activity is a crucial factor, which can be expressed in any one of the following ways. Sales capacity expressed as a percentage of maximum sales, sales value in terms of money, units sold, production capacity expressed in percentages, value of cost of production, direct labor hours, direct labor value, machine hours. The factors which are usually involved in this analysis are selling price, sales volume, sales mix, variable cost per unit, total fixed cost. Now, let's discuss about the approaches in break-even computation. The two major approaches to compute break-even are mathematical approach and graphic approach. Mathematical approach. In this break-even can be computed by engaging the technique of unit contribution, which is developed on the basis of marginal cost equation. The equation can be stated as follows. Sale is equal to variable cost plus fixed cost plus profit. Since at the break-even point, profit is absent, therefore, the same equation for this purpose can be rewritten as follows. Sales is equal to variable cost plus fixed cost, or sales minus variable cost is equal to fixed cost, or contribution is equal to fixed cost. The study of the equation reveals that sales revenue of each unit leaves a certain amount in the shape of contribution margin to meet fixed cost. Thus, in order to work out the required number of units to break even, where the amount of contribution will be sufficient to cover total fixed cost, the total fixed cost must be divided by the unit contribution. Graphic approach. In this approach, the break-even analysis is demonstrated graphically, which is commonly known as break-even chart. A break-even chart is a graphic approach to the study of the relationship of cost, revenue, and profit. The graphic instead of mathematical approach is often used because it tends to be more easily understood by the people whose acquaintance with mathematics is minimal, and it provides an immediate view of variable costs, fixed costs, and profit at any level of activity. Information for constructing a break-even chart can be obtained from the income statement of the concern. However, the total cost, that is the fixed cost, variable cost, and semi-variable cost, must be classified only into two categories of cost: fixed cost and variable cost. A brief description of these costs is as follows. Fixed cost. Fixed costs are the costs which remain fixed for all practical purposes to a certain level of activity. Once that level of activity is increased, the fixed cost will also increase to a specific degree. Examples of such costs are cost of plant and machinery, salaries, rent, etc. These costs are shown on the graph by means of a straight line. Variable cost. These costs vary in proportion to output. This means that they increase directly with the volume of production. Cost of material, wages, carriage, etc. are some examples of variable cost. For graphic application, these costs will be aggregated with the fixed cost to show amount of the total cost. Semi-variable cost. Semi-variable costs possess the characteristics of both fixed and variable cost. These costs demand special attention from the management in splitting them in fixed and variable costs. This is a simple break-even chart. The procedure for drawing the chart is as follows. Take x-axis as the volume of sales or capacity or production. Take y-axis as the cost or revenue. Having known at zero level of activity the same fixed cost is incurred, the fixed cost line drawn parallel to the x-axis. At zero level of activity, the total cost is equal to the fixed cost. Therefore, the total cost line starts from the point where the fixed cost line meets the y-axis. Next, plot the sales line starting from 0. The meeting point of the sales and the total cost line is the break-even point. It is also called break-even point because at this point there is no profit and loss either. The costs are just recovery by sales. If a perpendicular line is drawn to the x-axis from the BEP, the meeting point of the perpendicular and x-axis will show the break-even volume in units. If a perpendicular line is drawn to meet the y-axis from the BEP, that is the break-even point, the meeting point shows the break-even volume in money terms. Other details shown in the break-even charts are angle of incidence. This is the angle of intersection between the sales line and the total cost line. The larger the angle, the greater is the profit or loss, as the case may be. Margin of safety. This is the difference between the actual sales level and the break-even sales. It represents the cushion for the company. The larger the distance between the break-even sales volume and the actual sales volume, more comfortably the company can afford to allow the fall in sales without the danger of incurring losses. If the margin of safety is low, that is, if the distance between the actual sales line and the break-even sales line is too short, even a small fall in the sales volume will drive the company into the loss area. The position of break-even point should be ideally closer to the y-axis. This will mean that even a small increase in sales will immediately make the company break even. It should be noted that beyond the break-even point, all contribution, that is the sales cost and the marginal cost, will directly add to the profits. Break-even analysis provides the following important information for managerial decision making. Cost of production at various levels of operation, volume or level of production or activity required to attain a particular objective, profits expected or earned, and variation between cost of production and sales revenue. Break-even chart serves management as an effective tool in profit planning and other related decisions. The following areas of decision-making are usually exposed to the application of break-even chart. Budgeting. The effect of budgeted sales on profit can be easily estimated with the use of break-even chart. Such an analysis can be made for the entire business or for a part of it. The make or buy decision. Management is usually confronted with the problem decision of make or buy an item. This problem is solved to a large extent by the break-even chart. The pricing decision. Break-even chart also helps management in pricing decision as it enables it to explore the effect of price alternatives on product profitability. Sales mix analysis. The study of cost, volume, profit can be made easily with the help of break-even chart. Such a study can cover the entire product mix of a company instead of being limited to a single product. Each product would require a separate chart. The aggregate study of all charts can give a clear profitability picture of the given sales mix. The process shall be repeated for each mix, and then the comparison of various mixes can easily indicate the profitable sales mix. Break-even analysis is based on several assumptions. Effective use of this analysis calls for an understanding of the significance of these assumptions which are discussed. The behavior of cost is predictable. The conventional cost volume profit model is based on the assumption that the cost of the firm is divisible into two components, that is the fixed cost, variable cost. Fixed costs remain unchanged for all ranges of output. Variable costs vary proportionately to volume. Hence, the behavior of costs is predictable. In reality, however, it is not necessary for these assumptions to be valid over the entire range of volume. If they are valid over the range of output within which the firm is most likely to operate, referred to as the relevant range, cost volume profit analysis is a useful tool. The unit selling price is constant. This implies that the total revenue of the firm is a linear function of output. For firms which have a strong market for their products, this assumption is quite valid. For other firms, however, it may not be so. Price reduction might be necessary to achieve a higher level of sales. On the whole, however, this is a reasonable assumption and not unrealistic enough to impair the validity of the cost volume profit model, particularly in the relevant range of output. The firm manufactures a stable product mix. In the case of a multi-product firm, the cost volume profit model assumes that the product mix of the firm remains stable. Without this premise, it is not possible to define the average variable profit ratio when different products have different variable profit ratios. While it is necessary to make this assumption, it must be borne in mind that the actual mix of products may differ from the planned one. Where this discrepancy is likely to be significant, cost volume profit model has limited applicability. Inventory changes are nil. A final assumption underlying the conventional cost volume profit model is that the volume of sales is equal to the volume of production during an accounting period. Put differently, inventory changes are assured to be nil. This is required because in cost volume profit analysis, we match total cost and total revenues for a particular period. Uses of break-even analysis are as follows. It is simple and easy to understand. It is of utmost use in profit planning. It provides the basic information for further profit improvement studies. It is useful in decision making, and it helps in considering the risk implications of alternative actions. It helps in finding out the effect of changes in the price, volume, or cost. It helps in make or buy decisions also, and helpful in the critical circumstances to find out the minimum profitability the firm can maintain. The limitations of break-even analysis is the basis assumptions are at times baseless. For example, we can say that the fixed cost cannot remain unchanged all the time, and the constant selling price and unit variable cost concept are not acceptable. It is difficult to segregate the cost components as fixed and variable cost. It is difficult to apply for companies having large number of products or services. It is a short-run concept and has a limited use in long-range planning. It is a static tool since it gives the relationship between cost, volume and profit at a given point of time, and it fails to predict future revenues and cost. Marginal cost. Marginal cost, or the MC, is the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. Thus, marginal cost is the added cost of an extra unit of output. Marginal cost is equal to direct material plus direct labor plus other variable cost, which is equal to total cost minus fixed cost. Marginal cost equation. The algebraic expression of contribution is known as marginal cost equation. It can be expressed thus: S minus V is equal to F plus P, S minus V is equal to C, C is equal to F plus P, and in case of loss, C is equal to F minus L, where S is equal to sales, V is the variable cost, C is the contribution, F is the fixed cost, P is the profit, and L is the loss. Contribution. The difference between selling price and variable cost, or the marginal cost, is known as contribution or gross margin. It may be considered as some sort of fund from out of which all fixed costs are met. The difference between contribution and fixed cost represents either profit or loss, as the case may be. Contribution is calculated as contribution is equal to selling price minus variable cost, which is equal to the fixed cost plus profit or minus loss. It is clear from the equation that profit arises only when contribution exceeds fixed cost. In other terms, the point of no profit, no loss will be at a level where contribution is equal to fixed cost. Profit volume ratio, that is the PV ratio. The profitability of business operations can be found out by calculating the P by V ratio. It shows the relationship between contribution and sales and is usually expressed in percentage. It is also known as marginal income ratio, contribution sales ratio, or variable profit ratio. P by V ratio thus is the ratio of contribution to sales and is calculated as P by V ratio is equal to contribution divided by sales into 100. The ratio can also be shown by comparing the change in contribution to change in sales or change in profit to change in sales. Any increase in contribution obviously would mean increase in profit, as fixed expenses are assumed to be constant at all levels of production. P by V ratio is equal to change in contribution divided by change in sales into 100, which is equal to change in profit divided by change in sales. The importance of P by V ratio lies in its use for evaluating the profitability of alternative products, proposals, or schemes. A higher ratio shows greater profitability. Management should therefore try to increase P by V ratio by widening the gap between the selling price and the variable cost. This can be achieved by increasing sale price, reducing variable cost, or switching over to more profitable products. Break-even point is the point of no profit or no loss. At this point, contribution is equal to fixed cost. Break-even point can be calculated thus: Break-even point in units, which is equal to fixed cost divided by contribution per unit, which is equivalent to fixed cost divided by selling price divided by unit minus marginal cost divided by unit. Break-even point in sales, it is equal to fixed cost divided by contribution per unit into selling price divided by unit, which is equal to fixed cost divided by total contribution into total sales, or it is equivalent to fixed cost divided by P by V ratio. At break-even point, the desired profit is zero, where the volume of output or sales is to be calculated so as to earn a desired amount of profit. The amount of desired profits has to be added to the fixed cost given in the formula. Units to earn a desired profit is equal to fixed cost plus desired profit divided by contribution per unit. Sales to earn a desired profit is equal to fixed cost plus desired profit divided by P by V ratio. Cash break-even point. It is the level of output or sales where the cash inflow will be equivalent to cash needed to meet immediate cash liabilities. To this end, fixed costs have to be divided into two parts: fixed costs which do not need immediate cash outflow, that is the depreciation, etc., and fixed costs which need immediate cash outflow, that is rent, etc. Cash break-even point can be calculated thus: cash break-even point of output is equal to cash fixed cost divided by cash contribution per unit. Composite break-even point. Where a firm is dealing with several products, a composite break-even point can be calculated using the following formula. Composite break-even point in sales is equal to cash fixed cost divided by composite P by V ratio, or it is equal to total fixed cost divided by total contribution into 100, or it is equal to total contribution divided by total sales into 100. Margin of safety. Total sales minus the sales at break-even point is known as the margin of safety. Lower break-even point means a higher margin of safety. Margin of safety can also be expressed as a percentage of total sales. The formula is margin of safety is equal to total sales minus sales at break-even point, or it is equal to the profit divided by P by V ratio. Margin of safety in percentage is equal to margin of safety divided by total sales into 100. Higher margin of safety shows that the business is sound and when sales substantially come down, but not below the break-even sales, profit might be earned by the business. Lower margin of safety, as pointed out earlier, means that when sales come down slightly, profit position might be affected adversely. Thus, margin of safety can be used to test the soundness of a business. In order to improve the margin of safety, a business can increase selling prices without affecting demand, of course, reducing fixed or variable costs and replacing unprofitable products with the profitable one. Let's see some illustrative numerical problems to understand the various elements of break-even analysis. Illustration 1. A firm has supplied you the following information in respect of one of its products. Total fixed cost is 18,000, total variable cost is 30,000, total sales is 60,000 and units sold is 20,000. Find out A. the contribution per unit, B. break-even point, C. margin of safety, D. the profit, and E. volume of sales to earn a profit of Rs 24,000. Solution: selling price per unit is equal to 60,000 divided by 20,000, which is equal to Rs 3. Variable cost per unit is equal to 30,000 divided by 20,000 is equal to Rs 1.50. A. contribution per unit is equal to selling price per unit minus variable cost per unit, which is equal to Rs 3 minus Rs 1.50, which is equal to Rs 1.50. B. break-even point is equal to total fixed cost divided by contribution per unit, which is equal to Rs 18,000 divided by Rs 1.50, which is equivalent to 12,000 units. C. margin of safety, which is equal to units sold minus break-even point, which is equal to 20,000 minus 12,000, which is equivalent to 8,000 units or rupees 24,000. D. Profit is equal to units sold multiplied by contribution per unit minus the fixed cost, which is equal to 20,000 into rupees 1.50 minus rupees 18,000, which is equivalent to rupees 12,000. E. Volume of sales to earn a profit of rupees 24,000, which is equal to fixed cost plus desired profit divided by contribution per unit, which is equivalent to 18,000 plus 24,000 divided by 1.50, which is equal to 28,000 units. Illustration 2. From the following particulars, find out the selling price per unit if break-even point is to be brought down to 9,000 units. Variable cost per unit is rupees 75, fixed expenses is rupees 2,70,000, selling price per unit is rupees 100. Solution. Let us assume that the contribution per unit at break-even point sales of 9,000 is X. Break-even point is equal to fixed cost divided by contribution per unit. Contribution per unit is not known. Therefore, 9,000 units is equal to 2,70,000 divided by X, which means 9,000X is equal to 2,70,000, which is equivalent to X is equal to 30. Contribution is rupees 30 per unit in place of rupees 25. So, the selling price should be rupees 105, that is rupees 75 plus rupees 30. Cost volume profit relationship. The relationship between cost volume and profit are well defined in CVP analysis. With a given example, we can elaborately see the relationship. ABC Limited is a single product manufacturer whose selling price is 20 per unit and the variable cost is 12 per unit. The annual fixed cost is 1,60,000. The number of units produced and sold is 20,000. Now, if we analyze the CVP relationship, the contribution per unit is selling price minus variable cost, which is 20 minus 12, which is 8. The total contribution for 20,000 units is 8 into 20,000, which is equivalent to 1,60,000. Since the profit is equal to total contribution minus fixed cost, we get nil profit. That is, 1,60,000 minus 1,60,000 is equivalent to 0. This is the break-even point where the total cost is equal to the total revenue and the company has no profit and no loss. Let us see a few alternatives. If the fixed cost is 1,20,000, then the company may earn a profit of 1,60,000 minus 1,20,000, which is equivalent to 40,000. If the fixed cost is 2 lakhs, then it may end in a loss of rupees 2 lakhs minus 1,60,000, which is equivalent to 40,000. If the variable cost per unit is increased, say to 15 in the existing condition, then the contribution will come to rupees 20,000 into 20 minus 15, which is equal to rupees 1 lakh, and that will result in a loss of 1,60,000 minus 1 lakh, which is equal to 40,000. If the variable cost per unit is decreased, say to 10, then the contribution will come to 20,000 into 20 minus 10, which is equal to 2 lakhs. Then the profit will be 2 lakhs minus 1,60,000, which is equal to 40,000. This proves that the variation in the cost changes the profitability of the firm. If the cost decreases, profit increases and vice versa. Now we can see how the change in volume alters the profitability. If the sales volume is 10,000 instead of 20,000 as mentioned and all the other conditions being the same, the result will be 10,000 into 8 minus 1,60,000, which is equal to 80,000 loss. Likewise, if the volume is increased to 30,000, it will result in a profit of 30,000 into 8 minus 1,60,000, which is equal to 80,000. This shows that the profit increases with the increase in volume when other conditions are unchanged. Hope you are now able to understand the concept of break-even analysis and its application for an entrepreneur. We'll see you again. Till then, take care and goodbye.
Thank you.